Welcome to Iron Financial. This is the only place on the street where we forge stronger portfolios by stress testing companies, really testing them, right down to their molecular structure. And today, we are putting TKO Group Holdings directly into the crucible. The company just dropped its Q4 and full year 2025 earnings, and well, the market's reaction was swift and it was brutal. The stock took a haymaker right to the chin, dropping hard after hours. So we're here to do what we do best, a deep structural analysis. We're going to cut through all the noise and figure out if this company is built from solid iron or if this recent hit just exposed a core of rust. We are going to break down the numbers, inspect the engine room, find every single crack, and deliver the Iron Financial verdict. Let's get to work.
Okay, before we even put TKO under the microscope, you have to understand the battlefield. Look at this. This is the market we are all operating in right now. It is volatile, it's completely unforgiving, and it is punishing absolutely anything that even hints at weakness. We're seeing geopolitical risk, we've got mixed economic signals, a GDP report that just came in way below what anyone was expecting, and in a climate like this, perception becomes reality. Any sign of a weak foundation, any tiny hairline crack in a company's story, and the wolves just descend. This is not a market that gives you the benefit of the doubt. No way. It's a market that demands proof. It demands strength.
And that right there brings us to our core philosophy here at Iron Financial. You don't survive a storm like this with paper assets or some kind of speculative hype. You survive it and you thrive in it with a portfolio built from high-grade tempered iron. We look for companies with real structural integrity. Companies with wide moats, solid balance sheets, and consistent, predictable cash flow. We are looking for businesses that can take a punch from a volatile market, stay on their feet, and just keep moving forward. It is not about finding what's popular, it's about finding what's durable. It's about building a financial fortress, brick by brick, with assets that will not crumble under pressure.
Okay, that's the poetry. Now, let's get down to the facts. That is the billion-dollar question on the table right now, isn't it? Is TKO Group one of those ironclad assets you're always talking about, or is it just a piece of scrap metal that's starting to rust? Because the market just landed one heck of a heavy blow. That earnings report came out, and investors immediately, and I mean immediately, ran for the exits. So we need to know, right now, does this company have the chin to take a punch like that and keep fighting, or is this the start of a 10 count? All the philosophy in the world doesn't mean a thing if the asset itself is flawed. So let's just cut to it. Iron or rust?
Okay, let's dive into this. The only way to answer that question is to go straight to the tail of the tape. We're going to dissect the official numbers that just came out of TKO headquarters. This is the main event, folks. We're going to look at the revenue, the profits, or, the lack of profits, and the market's immediate gut reaction. Let's forget the speculation and the press releases for just a moment. The numbers, they don't have a PR department. They tell the unvarnished truth about the health of this company in the fourth quarter of 2025. This is where we start building our case, for or against.
So on the surface, the top-line number looks like a total knockout. In the fourth quarter, TKO pulled in revenue of $1.038 billion. That is a 12% increase year over year. Come on. In this economic environment, double-digit revenue growth is nothing to sneeze at. That suggests the core products, the fights, the events, the media content, are still in incredibly high demand. It shows that people are still tuning in and they're still paying up. For a company built on live events and media, this is the first and most basic health check. And a 12% jump, that's a very strong pulse. It shows the heart of the business is pumping.
A strong pulse? Are you kidding me? The patient went into cardiac arrest the second that report hit the wire. The market took one look at that strong report and immediately sent the stock down 2.5% in after-hours trading. That is not a vote of confidence. That's a stampede for the door. You can't just cherry-pick the top-line revenue number and completely ignore how the people with real money on the line reacted. The market is a voting machine in the long run, sure, but it's a weighing machine right now. And in this case, it weighed TKO's report and found it wanting. Something under the hood is clearly scaring investors off, no matter what that 12% headline says.
And this slide right here perfectly illustrates that disconnect. It's night and day. On one hand, you have the CEO, Ariel Emanuel, in the official press release talking about meaningful momentum. He's pointing to the strength in the company's crown jewels, UFC and WWE. That's the story the company wants you to hear. But then, on the other hand, you have the market story, captured perfectly by this Investing.com headline. TKO shares fall on earnings miss and weak 2026 revenue outlook. One side is selling strength and momentum, the other side is screaming about misses and a weak future. Our job is to figure out which of these two stories is built on a more solid foundation.
And here it is, the first major crack in that foundation. And it's not even complicated.
Wall Street, the collection of supposedly the smartest analysts covering this stock, they built their models and came to a consensus. They expected TKO to deliver a profit of 26 cents for every single share. That was the benchmark. That was the hurdle they had to clear. And what did TKO actually deliver? An 8-cent loss per share. That's not a miss, that's a complete whiff. You cannot talk about meaningful momentum when you swing for a home run and don't even make contact. This right here is the number that triggered the sell-off. It's one thing to grow your sales, it's another thing entirely to turn that growth into actual profit for your shareholders. And on that front, they failed.
All right, so we have a clear conflict. We've got strong revenue growth on one side, but a big earnings miss and a nasty market reaction on the other. To understand what's really happening, we can't just stay at the 30,000-foot view. We have to pop the hood. We need to look at the individual components of this corporate machine, the core business segments that are supposed to be driving this thing forward. TKO isn't just one monolithic company. It's a collection of very distinct businesses. And by analyzing their individual performance, we can see where the power is really coming from and, where the dead weight is.
And wow, this chart, it brilliantly illustrates the core story inside TKO. Just look at this thing. It lays everything out. The two main engines, the two absolute pillars of this company, are firing on all cylinders. You've got WWE, the sports entertainment juggernaut, with revenue up a massive 21% in the quarter. Right behind it, you have UFC, the premier brand in mixed martial arts, with revenue growing by a staggering 17%. These are not small numbers, people. This is explosive growth in the segments that matter most. This right here, this is the iron core of the company. It shows that the fundamental appeal of their main products is stronger than ever.
So let's drill down into UFC for a second. That 17% jump brought their quarterly revenue to over $401 million. And this wasn't some kind of fluke. No, this was driven by the heavy lifting of core business fundamentals. Partnership and marketing revenue was up significantly, which means more blue-chip brands are paying top dollar to get their name next to the UFC. Their media rights fees are escalating, which is just contractual guaranteed money hitting the books, and they're getting higher site fees from international events, which proves their global appeal and their expansion strategy is actually paying off. This is a picture of a healthy, growing, and strategically sound business. It's a well-oiled machine.
And now look at WWE. Man, the growth here is even more impressive, up 21% to nearly $360 million for the quarter. And the driver here is crystal clear: monster media deals. The contractual escalations in their existing rights, that's already providing a solid base, but the real story is the impact of those new, absolutely transformational distribution agreements with giants like Netflix and ESPN. This is the definition of long-term, predictable, high-margin revenue. Locking in deals with the biggest players in media de-risks their entire business model for years and years to come. And just like with UFC, they're also seeing growth from new partnership deals. This segment isn't just growing, it is fortifying its financial future.
Okay, hold on. That's a great story. You've painted a beautiful picture of the two shiny engines just firing on all cylinders. It's very compelling, but you're conveniently ignoring that third bar on the chart. The one that isn't growing, the one that's actively shrinking, the one that's sputtering and spewing smoke while the other two are trying to pull the entire vehicle forward. You can't just talk about the strengths. A true structural analysis, a real iron financial analysis, has to focus on the weaknesses, and there's a big, glaring one we need to talk about.
There it is, the IMG segment. Revenue didn't just slow down, it dropped, a 9% decline in the fourth quarter. So while UFC and WWE are putting up monster growth numbers, this part of the business is actively moving in the wrong direction. This is a significant drag on the overall company performance. You can't have a third of your engine fighting the other two-thirds. This is what the market sees. It sees an unbalanced machine. It sees a point of failure. This negative growth is a major contributor to that earnings miss we talked about earlier. It's the anchor holding back the entire ship.
That's true. It was a drag in Q4, no doubt. But for a proper structural analysis, context is absolutely crucial. Now let's zoom out for a second and look at the full-year picture for IMG, because this is where the story gets a little more nuanced. For the full year, IMG revenue dropped a massive 31%. But you have to look at the reason. The 2024 numbers were artificially inflated because they included all the revenue from the Paris Olympics. That's a massive, non-recurring event. You can't expect them to replicate that every single year. So while the Q4 drop is a concern, the full-year comparison isn't as catastrophic as it looks at first glance. It's what we call a tough comp, and we have to acknowledge that.
An excuse is not a result. Come on, a tough comp doesn't pay the bills. The fact remains, this segment posted an adjusted EBITDA loss of nearly $4 million in the fourth quarter. It's not just that revenue is down, the segment is actually losing money on an operational basis. Yeah, sure, for the full year they eked out a profit of $160 million, but a Q4 loss is a serious problem for a company of this size and a huge signal that the trend is heading in the wrong direction as we enter the new year. You can't just brush this off. This is a crack in the armor, plain and simple. It's a fundamental weakness that needs to be addressed, not explained away.
You know, you're right to focus on those negative signals, because that brings us to the real heart of the issue here. What truly spooked the market wasn't just the earnings miss or the weakness in one segment, no. It was the blueprint for the future. Wall Street is a forward-looking machine, always has been, and when TKO unveiled its guidance for 2026, that machine flashed red all over the place. Investors looked at the company's own map for the year ahead, and they did not like the destination. And here it is, folks. This is the smoking gun. This is the knockout punch. Wall Street analysts had built their models. Their consensus expectation was that TKO would generate just over $6 billion in revenue for the full year 2026. That number was baked into the stock price. Then, management came out with their own official guidance. And their midpoint forecast? $5.725 billion. That is a gap of nearly $300 million. Management is telling the world, in their own words, that they are going to bring in almost $300 million less than everyone was expecting. This is a massive downward revision of expectations, and it's coming from inside the house.
And this is exactly why the stock got absolutely hammered. It goes right back to that headline we saw earlier. The market can forgive a one-time earnings miss. It can even tolerate a weak quarter from a single segment, but what it cannot and will not tolerate is a company that signals weakness for the future. This guidance tells investors that the growth story they bought into is not as strong as they believed it was. It's like a builder telling you the skyscraper you invested in is now only going to be 80 stories tall instead of 100. It fundamentally changes the value of the entire project. This is the core reason for the sell-off.
But wait, management isn't just taking that punch without fighting back. They are countering that fear, that weak guidance, with the ultimate power move. They announced a plan to buy back $1 billion of their own stock, set to launch in March 2026. A share buyback of this magnitude is the single loudest signal management can send that they believe their own stock is undervalued. They are putting their money, $1 billion of it, where their mouth is. They are basically telling the market, you're wrong to sell, this stock is cheap, and we're going to use our own cash to prove it. This is a massive vote of confidence from the people who know the business better than anyone else. So after all that, after looking at the good, the bad, and the really ugly, we are back to the main event. We have a company with booming core businesses, but a weak outlook and a struggling third wheel. We have a stock that's been beaten down by the market, but a management team that's stepping in to buy it back with both hands. So what is the verdict? We need a clear, actionable conclusion. For you, the investors watching, is the current lower stock price an opportunity to buy a solid company on sale, or is it a trapdoor leading to even further losses?
So here's the deal. It all comes down to weighing these two sides of the scale. On one side, you have the iron core. The operational strength of UFC and WWE is just undeniable. They are growing revenue and, more importantly, adjusted EBITDA at a phenomenal rate. The company is a cash flow machine, generating over $1.1 billion in free cash flow in 2025. And management is backing all that up with a $1 billion buyback. That is the bull case. On the other side, you have the cracks. The weak 2026 guidance is a major overhang. The drag from the IMG segment is real, and the choppy overall market is punishing any company that shows even a hint of weakness. That is the bear case.
So here it is, the iron financial verdict. The market has become myopic. It is laser-focused on that weak 2026 guidance and the issues at IMG, and it is punishing the stock as if the entire structure is about to collapse. We believe this is a mistake. The market is mistaking a temporary stumble, a tough comp for IMG, and a conservative forecast for a deep structural weakness. Our analysis shows that the core of this company, the UFC and WWE segments, is made of solid iron. They are cash-gushing, high-growth businesses with long-term, locked-in media deals. The massive free cash flow and that aggressive share buyback are testaments to that underlying strength. The recent price drop, in our view, has created a major disconnect between the stock price and the fundamental value of the core assets. The market has overreacted, creating a potential opening for long-term investors to acquire an ironclad business at a discounted price. That's our analysis. The decision, as always, is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.